Imagine a thought experiment. 100 investors. 99 of them decide to stop analyzing stocks. They just buy the index. Every month, automatically, there is still one person left, one active investor, still doing the work, still reading the earnings reports, still figuring out what things are worth. If that one person stops, who decides what prices are? This is no longer a thought experiment. By 2024, indexed U.S. long-term funds had become the majority of mutual fund and ETF assets. By March 2026, the Investment Company Institute counted $19.09 trillion in indexed long-term mutual funds and ETFs versus $17.12 trillion in active ones. But here's the question the victory has raised. What happens to a market when a historically large share of capital has stopped asking what individual securities are worth? The passive trap. How index funds are quietly breaking the market they were built to track. The intellectual foundation for passive investing rests on a single, almost elegant mathematical argument made by Nobel laureate William Sharpe in 1991. The paper was short, direct, and built like a proof. Its title was The Arithmetic of Active Management. Sharpe's argument goes like this. Every stock in the market is owned by someone. You can divide all investors into two groups. Passive investors, who hold every stock in proportion to its market weight and never deviate, and active investors, who hold portfolios that differ from the market. Together, they hold the entire market. If passive investors hold exactly the market, by definition, then active investors, in aggregate, must also hold exactly the market. What one active manager overweights, another must underweight. Before costs, the average active manager earns the market return. After costs, management fees, trading costs, and taxes, they must earn less. This is not a prediction. It is arithmetic. This is not just theory. The empirical evidence for passive investing is overwhelming. S&P Dow Jones Indices publishes the SPIVA scorecard, an annual report comparing active fund performance against passive benchmarks. The pattern is consistent and unforgiving. Over 20 years, about 93% of active U.S. large-cap funds underperformed the simple act of buying and holding the S&P 500. The argument for passive investing is backed by data that spans decades, multiple asset classes, and multiple countries. It is one of the most robust findings in empirical finance. The question this episode asks is not whether passive investing has been a better choice for most investors historically. It has. The question is, what happens when passive becomes dominant? Does the foundation it stood on begin to shift? In 1980, 11 years before Sharpe published his arithmetic, and decades before passive investing became mainstream, two economists named Sanford Grossman and Joseph Stiglitz published a paper in the American Economic Review with a stark title, On the Impossibility of Informationally Efficient Markets. Their argument was not that markets are irrational, it was more precise and more uncomfortable. They argued that perfectly efficient markets are a logical impossibility because of the following contradiction. If prices perfectly reflected all available information, there would be no profit available to any investor who spent time and resources gathering that information. If there is no profit to gathering information, rational investors stop doing it. If no one gathers information, prices stop reflecting it. And if prices stop reflecting information, they are no longer efficient. The system contradicts itself. Their conclusion: markets exist in equilibrium, not because they are perfectly efficient, but because they are efficiently inefficient. Efficient enough that most investors cannot beat them, inefficient enough that a few can, which keeps price discovery alive. Passive investing is, in its essence, a free rider. That is not a pejorative. It is a precise economic description. A passive investor benefits from the price discovery work done by active investors without contributing to that work or paying for it directly. As long as passive investors are a minority, this is fine. The active investors still have enough incentive to keep prices informative. But Grossman and Stiglitz's logic implies something uncomfortable as passive grows. When a marginal dollar that would have been valuation sensitive moves into indexing, the pool of capital doing price discovery can shrink. By March 2026, indexed long-term mutual funds and ETFs were $19.09 trillion versus $17.12 trillion active. Passive share depends on definition. A conservative ownership estimate and a broad fund market measure are not the same thing. Do not mix the measures. There is a precise way to describe what is different about passive investing. In a normal market, when a stock's price rises, some buyers become less interested. Demand curves slope downward. This is what keeps prices anchored. Passive funds are different. If a stock's price rises and its market capitalization grows, a market cap-weighted index gives it a larger weight. Existing index funds do not need to buy more merely because the price rose. The position grows with the price. But the next dollar of index tracking inflow is allocated at the new, larger weight, and the strategy does not become less interested just because the valuation is higher. Passive demand is not upward-sloping demand in the normal sense. It is mechanically price-insensitive demand. Researchers found evidence that aggregate demand elasticity for stocks has declined as passive ownership has risen. The first distortion is the most visible: extreme concentration. Index funds are market cap weighted. A company's weight in the index equals its market capitalization as a fraction of the total. This creates a feedback loop with a specific mathematical structure. As passive inflows enter the index, they buy all stocks proportionally, but larger stocks receive larger absolute dollar amounts. Higher price means higher market cap. Higher market cap means a larger weight in the index. A larger weight means the next dollar of passive inflow allocates more dollars to that stock. The loop is self-reinforcing. It does not require fraud, irrationality, or conspiracy. It is the mechanical consequence of market cap weighting at scale. Current top 10 concentration exceeds the dot-com peak, though earnings support is stronger today. Concentration alone does not imply a bubble, but the feedback mechanism is real. The second distortion is more subtle, and in some ways, more revealing. It is called the index inclusion effect. When a company is added to the S&P 500, index tracking funds must trade around the inclusion to minimize tracking error. That mechanical demand can temporarily elevate the stock's price above fair value. In the early 1980s, this effect was modest, an average abnormal return of 3.4% around announcement. By the 1990s, as indexing grew, the effect peaked at 7.6%. By the 2010s, the effect had fallen to 0.8%, barely distinguishable from zero. The explanation is active arbitrage. Active investors learned to anticipate index additions before they were announced. Then Tesla was added to the S&P 500 in December 2020 with a 32-day gap between announcement and implementation. The abnormal return between announcement and inclusion was over 50%. The clean conclusion is narrower and stronger. The index effect disappeared because active arbitrage adapted, and Tesla showed when it can return. The third distortion strikes at the core promise of index investing: diversification. An S&P 500 index fund holds 500 stocks. It sounds diversified, but diversification is not just the number of names in a portfolio. It is also how independently those names behave when flows hit the market. When passive funds receive inflows, they buy many index constituents together. When they face redemptions, they sell many constituents together. That coordinated flow can make stocks sharing an index move more together than their underlying businesses alone would imply. Jiang, Vallanos, and Zhang published related evidence in the Review of Financial Studies in 2025. The careful version is this: passive flows can increase co-movement and concentration risk, but causality is debated. The fourth distortion is the most structural and the least discussed. Many index funds that track the S&P 500 are incentivized to execute at or near the official closing price because the index's official value is calculated using closing prices. That creates a strong incentive for benchmark-sensitive execution to cluster near the market close rather than being evenly spread through the trading session. State Street published data in January 2026 showing that by December 2025, the U.S. market's closing auction was absorbing 15.39% of all daily trading volume. In developed Europe, the equivalent figure was 34.82%. In Japan, the closing figure was 23.8%. The final print has become more important and increasingly reflects mechanical benchmark alignment as well as new information. The evidence presented so far is real, but but the conclusions one draws from it require care. Here are 4 things the data does not prove, and that the most serious academic voices in this debate explicitly caution against. Correlation is not causation. Concentration may reflect real earnings power. Active arbitrage adapts. Passive has real investor benefits. Evidence is real. Interpretation needs care. Passive investing was built on one of the most solid empirical findings in the history of finance. It gave ordinary investors a low-cost, reliable way to participate in economic growth without being systematically robbed by fees and underperformance. The concern is not the passive investing was wrong. It is that its success has created a structural condition that its founders did not fully model. When a historically large share of capital has, by design, stopped asking what individual securities are worth, the valuation-sensitive capital that remains carries a larger price discovery burden. The data is real. The mechanisms are documented. The magnitude of the effect and its trajectory are still being written. 100 investors, 99 buy the index. 1 does the work. What if that one decides it is no longer worth it? Whether that is a problem, and how serious a problem it is, depends on how far the shift has gone and how adaptive markets turn out to be. The experiment is ongoing. The outcome is not yet in the data. This video is for educational purposes only. Nothing here is financial advice, investment advice, or a recommendation to buy, sell, or hold any investment product. Claims about passive market distortion are based on published academic and institutional research and remain active areas of debate.